Have you ever stopped to think if you're leaving your entire financial legacy exposed to just one single fragile system? I mean, most people spend their entire lives relying on one country, one currency, and one market to secure their future. But, in today's landscape, that is a literal recipe for immense vulnerability. Welcome to This Explainer. Today, we're completely moving away from those fragile single-country investments. Instead, we're going to look at how to build what the smartest investors use, a dual-engine wealth machine. We're breaking down the cross-Atlantic hybrid wealth framework. It's essentially a strategy that synthesizes rapid growth with ironclad preservation. So here's the exact blueprint we'll follow today. We'll start by decoding the two philosophies of wealth, then the American growth engine, and the European security core. After that, we'll analyze the architecture of corporate moats, and finally, wrap up with building your global fortress.
Okay, part one, two philosophies of wealth, the great divergence.
To really understand how to build unstoppable wealth, we first have to recognize that there are two completely different mindsets controlling the world of money, and they are divided right down the middle of the Atlantic Ocean. The American strategy is basically an aggressive offensive powerhouse. It's all about high velocity, maximizing growth, and chasing those hyper-compounding tech stocks. The corporate landscape there is uniquely brutal, but uniquely rewarding, because it essentially commoditizes the future. But then, on the flip side, we have the European strategy. Europe doesn't really think in terms of quarters, they think in terms of centuries. This is your impenetrable, multi-generational defensive shield. The focus here is completely on preserving capital, protecting privacy, and holding stable legacy assets that can literally survive regime changes and monetary collapses. Now, amateur investors love to argue over which of these markets is better. But the smartest investors? They don't pick one over the other. The crucial point here is that true financial mastery requires synthesizing these two distinct philosophies into a single, unstoppable blueprint. Think about it. If you only go American, you're climbing a mountain of volatility and risk losing everything when a bubble pops. If you only go European, you suffer stagnation and end up losing the race against inflation. You absolutely need both to perfectly neutralize their respective weaknesses.
All right, move into part two, the American growth engine, the sword.
Let's start building this machine, beginning with the greatest wealth generation engine in human history. We're dedicating 60% of our total investable capital entirely to high-velocity American growth, while keeping 40% reserved for our European security core. Think of this 60% as your active frontline soldiers. Their one and only job is to capture market share, exploit technological shifts, and compound your wealth at a rate that just completely outpaces inflation. But how exactly do we deploy that 60%?
Well, look at this number, 95%. That is the percentage of active fund managers who completely fail to beat the broader market over a 10-year horizon. It's crazy, right? If professional institutions with literal supercomputers can't pick winning stocks consistently, we definitely shouldn't try to either. And that's exactly why this strategy removes human emotion entirely and relies purely on mechanical indexing.
So here's exactly how that 60% American growth engine breaks down. 40% of it forms your core equity foundation, and that's through broad S&P 500 indexing. Remember, the S&P 500 isn't just a random list of stocks. It is a living, breathing Darwinian machine that automatically dumps losers and rewards the most cash-generating corporations on Earth. Then we take the remaining 20% and put it into asymmetric risk capital. This is where you put on your Silicon Valley venture capitalist hat. You're making highly targeted bets in AI, biotech, and decentralized ledgers. Why? Because your downside is strictly limited to whatever you initially invested, but your upside is mathematically unlimited. Just one massive winner can cover a dozen small losses. Which brings us to part three, the European security core, the shield. Let's cross over to the other side of the Atlantic and see how this builds our impenetrable defensive shield. Because, let's face it, your sword is pretty useless if you don't survive the battle in the first place. For our 40% security shield, 15% goes straight into European luxury and industrial moats. We're talking about legacy giants like LVMH or Nestlé. They don't rely on speculative future cash flows. They are cultural fortresses with immense pricing power. Next, another 15% goes into hard assets and real estate. This capital completely exits the digital brokerage ecosystem. Think physical Swiss gold held in a non-bank vault or prime agricultural land. It carries absolutely zero counterparty risk. And finally, the last 10% is parked safely in sovereignty cash reserves. Now notice how we handle that 10% sovereignty cash reserve. We don't just leave it sitting in one local bank. We divide it evenly across three of the world's haven currencies, the US dollar, the euro, and the Swiss franc. Historically, the Swiss franc is the ultimate global safe house, mostly thanks to Switzerland's low national debt and constitutional mandates against persistent deficits.
By splitting your cash up like this, you ensure absolute liquidity. Even if your local banking system suddenly experiences a total freeze or a capital control restriction, you remain fully operational. No panic required. Let's move to part 4, architecture of corporate moats, structural protection. Okay, so we've talked about the allocations, but let's ground this strategy in reality for a second. What exactly gives these specific assets their unbreakable power? Well, it all comes down to corporate moats. These are structural barriers that protect a business from the relentless cutthroat forces of capitalism. In the American growth engine, the supreme moat is the network effect. That's when a product, say a global software platform or a social media network, becomes exponentially more valuable as more people use it, which creates a massive barrier to entry. Sure, a competitor might copy the code, but without the users, the clone is completely worthless. This is the exact structural architecture that drives those hyper-compounding, high-margin cash flows of American tech monopolies. But over in the European security core, the moats look totally different. They rely heavily on something called the Veblen good effect. A Veblen good is an item whose demand actually goes up as its price rises. Brands like Hermes or Rolex deliberately restrict their supply to create this illusion of absolute exclusivity. When inflation spikes, traditional manufacturers really struggle to pass those costs on to consumers. But a premier European luxury house, they just effortlessly raise their retail prices by 15%, frame it as enhanced exclusivity, and their affluent consumers pay it without a second thought. It is literally the ultimate inflation hedge. And speaking of inflation, this framework really forces us to acknowledge the reality of the modern fiat system. Because major currencies are unbacked, proponents of this strategy argue that inflation isn't just some accident. They view it as a deliberate structural feature designed to liquidate sovereign debt right at the consumer's expense. Now, regardless of where you stand on that, this perspective is exactly why cross-Atlantic diversification is treated as a strict mathematical necessity to protect your purchasing power. Executing this, though, requires a total mindset shift. Humans are hardwired for herd behavior. We panic sell during crashes like a toddler losing a favorite toy, and we FOMO buy during bubbles. The hybrid investor consciously deprograms these evolutionary responses. When the American tech market drops 30%, the average retail investor panics. But you just look at your dashboard. Your European luxury stocks are paying dividends, your Swiss gold is holding its value, and your haven cash is fully liquid. You don't see an emotional crisis. You just see a purely mechanical phenomenon. Basically, a generational clearance sale where you can buy irreplaceable tech monopolies at deep discounts. All right, part 5, building your global fortress, the execution phase. So, how do we actually bring all this theory back to reality? Let's lay out the actionable steps to scale this system. And it works whether you're starting with $1,000 or $10 million. There are 4 mechanical execution phases. Step 1, the audit. Look closely at every asset you own. If more than 70% of your net worth is tied to one country or one currency, you are exposed. Step 2, rebalance. Take 60% of your capital and route it into your American growth engine using those low-cost index funds and asymmetric risk bets we talked about. Step 3, construct. Take the remaining 40% completely out of the high-velocity ecosystem and build your European security core with luxury conglomerates, hard assets, and distributed cash. And step 4, optimize. This means utilizing tax-advantaged accounts or specific structures like Irish-domiciled ETFs to cut your dividend withholding tax drag in half. The fundamental logic here remains exactly the same, totally regardless of your portfolio size. Now, for the really advanced investor, let's look at how this scales into a multi-tiered holding architecture. The golden rule here is you never want your operating businesses and your accumulated wealth in the same legal bucket. So at the very top, you establish an international trust or foundation, maybe in Liechtenstein or Switzerland. Right below that sits a top-tier holding company, often in Luxembourg or the Caymans. And below that, it splits. Your active, high-velocity commerce runs through an operational shield, like a Delaware or Wyoming LLC. But your profits? They get paid up and immediately routed down into your capital storage vault, like a Swiss private bank. You're completely decoupling your aggressive operational growth engine from your secure storage vault. So here's your ultimate cheat sheet summarizing this entire cross-Atlantic framework. We've got 40% in core US equities driven by global network effects, 20% in asymmetric risk out on the tech frontiers, 15% in European legacy driven by intangible brand equity, another 15% in hard assets backed by physical scarcity, and finally, 10% in sovereignty cash protected by statutory privacy laws. This matrix is your clear, actionable target to verify that your capital is allocated strictly according to the rules of wealth preservation and velocity. Which brings us to our final question.
Are you going to leave your financial legacy exposed to a single fragile system, or are you ready to build a dual-engine machine that actually thrives in chaos? The old model of just having a single corporate job and a local bank account, that's increasingly looking like a recipe for liquidation by inflation. The modern world really requires you to be globally minded, structurally insulated, and psychologically detached. The tools to do this, the international banks, the digital brokerages, the legal frameworks, they are all completely accessible to you right now. It's time to stop playing the financial game on amateur mode. Thanks so much for joining me on this explainer, and I'll see you next time.